Hi guys, good evening and welcome to Money Control Markets Weekly. I'm Karunya Rao, and as always we're here to tell you what the big trends in the markets are and what is it that you should be keeping on your watch list before you look at re-strategizing your investment journey. Joining me in conversation today is Swati Kulkarni of UTI Mutual Fund. Hi Swati, thank you for joining in today.
Yeah, thanks, Karunya. It's our pleasure.
Well, if the markets continue to keep seesawing like the way they have been, what is it that retail investors should make of it? Because a lot of, especially first time investors, are quite nervous and quite unsure of what should be their strategy to stay on in the market.
So I have a different perspective on this volatility in the market. First of all, it is given that the equity markets will be volatile. I guess the volatility also signifies that there are different type of investors that survive on the same stock market. So, like for example, there will be traders who are looking for this volatility, and this volatility also gives the long-term investors like us an opportunity to pick up stocks at a very attractive valuation. So the long-term investors would typically look at stock market as a means to board on the wealth generation path. And therefore, I think the first-time investors actually should not get unnerved by the volatility that we are seeing. Any period in past history, if you go, the short-term periods have always been volatile. But when you look at a bigger picture, the picture looks like a good amount of return from the equity markets over many years. But yeah, the window of short term would always look much more volatile. So I guess investors should focus on the long term, and typically we are in a globalized world, so there will be a lot of uh, variables that could affect us, whether it is the interest rates going up, the liquidity, or the geopolitical situation. So narrative will always differ, and it will be having some narrative or the other from time to time. But as I said, coming back, that it gives opportunity to different type of investors from time to time. Traders, investors, also there are hedge fund investors who are looking at opportunities of absolute return. The big picture again is when you look at FIIs, for example. Today they own 18% of listed market cap, and domestic institutions along with the retail guys are holding only about 14%. So the big picture suggests that yes, there are long-term investors who are increasing their ownership into Indian listed space.
Yeah. Okay. But for how long do you think all of this, jitteriness or this instability in the market will continue? Because we are well into the second half of 2022, and if the way things are, if the way things continue to go on like the way they are, we could be looking at, or maybe I should ask you, could we be looking at negative returns for the year?
So Karan, I don't know how the returns would pan out in the short term, and we are not equipped, or nor our processes focusing on that, because we don't know exactly how the markets will shape up. There are, as I said, there are pulls and push, which drive the market movements. Just to give you a very recent example of COVID times, the opportunities that one could lose because of this the tendency to predict market was a huge opportunity loss when in March 20 markets reached the bottom. So I would say that it's better to look at the allocation and the valuation as a guardrail to kind of manage your equity allocation. And if you have a horizon as your friend, I think you can perhaps even out these intermittent volatility, and that's the message that is a solid message that history tells us. As far as the correction phase, I remember distinctly 2010 November to almost December 2011, when the all over the world the tightening cycle started. The correction lasted for around 400 days, more than a year, and that correction put together had taken away about 27% from the market. So there will be times, testing periods, not to suggest that this correction would be that long length of time. We don't know that, but I think what is important is that take on the opportunities, maybe have a structured way to increase your allocation, and then use these volatile periods to build a lump sum investment, and focus on what is the overall allocation that is good for an individual, and stay disciplined with that equity allocation, rather than getting unnerved by the greed and fear that typical human behavior displaces.
But if we look at the trend for mutual funds, domestic mutual funds, even they have cut back or rather curbed their exposure to equities in the months gone by. Th- Should that be worrying to us as a trend going forward, or was it a one-off, month when they were profit
So,
booking?
if you talk about our equity allocation in the funds, the cash levels have not changed much. So, I would say that they have remained in a strict band of 1 to 5%. It is possible that the volatility, as you mentioned, that the new investors, particularly, they get really perturbed by the volatility and the correction in the market, and there is a tendency of stopping the SIPs, or delaying the investment. So that would have reflected in the flows into the mutual funds in recent times. But I guess these are all a sign of the retail sentiment. If with the rising in markets, the flows will come back again. So unfortunately, investors should look at the valuation comfort and decide the flows, rather than we get a tendency to stay confident when returns are there, and then we invest. So I think the best time to invest are when the returns are poor, the valuations are on your side, and that is the time when you make good returns.
So
Because the
what is
earning also, along with the re-rating of P multiple or any other multiples, would be helpful to make those extra returns.
so what's your reading of current valuations then?
So valuation on trailing 12 months basis on a 10-year average level at 22 times of for Nifty 50. And when you look at 1 year forward multiple, price to earning multiple, we are still in a comfort zone, but above average, I would say. So I would say that such volatile times could actually bring that valuation towards the average levels, and that is a time to not to go away from the market, but yes, correct your equity allocation. Just one data point: we run a multi-asset fund, and this fund in last year around August 21, this fund had started to reduce its allocation to equity. So the allocation had come down to about 45%, and that allocation had gone to about 65% pre-July, because the markets corrected, and the model suggested that we should be increasing allocation to equity. And now with the rally in July, about 9% rally in the markets, we have seen the value, actually the allocation dipping to about 57%, and the correction actually again increases this to 65%. So I would say that with the current valuation, that is the rational, or without any fund manager interference, this model suggests 65% allocation to equity.
But given the volatility in the market, has demand for gold funds, silver ETFs, etc., gone up at all in the recent past? How has the demand been?
So I guess gold has been underperforming, of recent times, and it's basically when the interest rates have started to go up, there is a movement towards developed markets, and what we have seen is typically FIs also have pulled up about $25 billion from India particularly. So the risk of trade has what we have seen, but when it comes to I think the precious metal, that is the correction that we have seen, and the return on the gold funds especially are more dominated by the currency depreciation that we are seeing, because the gold funds in India are quoted at in rupee terms, and because the currency has depreciated versus dollar, we have those returns reflecting on these funds. But I guess gold has not been that well performing asset class if you see the 1 year returns. Sectors like automobile have done well, and that strategy actually is the best performing over last 1 year, I would say.
Okay. So, in terms of asset allocation at times like this, when various assets are being volatile, being very, unstable in nature, how should one go about planning their portfolio, or creating, or even restructuring their portfolio?
Sure. So one thing is there that the with rising interest rate, the equity actually should the valuation of equity should take a breather, because we are valuing the discounting rate goes up, and therefore the value of the future cash flows goes down, and there is some bit of correction which might come because of the rising interest rate. So that's the fundamental part or a theoretical part of finance. But as that the some part of inflation is good for companies which are able to pass on the price hikes. And in recent times what we have seen is the commodity price hike has been so sharp that companies have not passed it on, and therefore we have seen their margins taking a beating. The volumes have got affected. Going forward, we think that with the normalization of commodity prices, there could be a possibility of margins going up, the volumes could come back, and therefore the operating leverage benefits could also come. And in such a scenario, what we think is that the small moderate inflation actually is good for equity. So it would be offsetting as far as the interest rate increase and the inflation, moderate inflation, that would have on the equity side. And therefore I think one should be constructive on equity. We are also like looking at the positives of Indian markets. For example, capital investments uh, are set to go up. Private capex is set to go up, because we already know that the average capacity utilization in the country has inched up now. And some amount of increase in the interest rates actually can be easily passed on. Talking about EMIs, for example, let's say a 5 year loan on a car purchase, the EMI for 200 basis point increase in the interest rate goes up just by 500 points. For a housing loan, which is a 20-year product, the EMI goes up only by 4,000. So, it's not so much of a dent as far as the personal savings are concerned. And I look at India as a saving country, or the people have the saving habits. It can go up. We have 165 trillion of deposits. So, a small portion of that, if it comes into equity markets, definitely that could be a big opportunity. So I would say that one should look at what is the desired asset allocation for them. You see, we have seen that equity is the best asset class as far as the inflation beating returns in history is concerned. And therefore, if one has to maintain their standard of living and pursue their interest, maybe travel, education, that is the time when we need to consider these aspects as far as equity asset allocation is concerned, to keep up the standard of living and to keep up uh, the happy lifestyles that we are used to.
In terms of equities, any themes that you guys are exploring or you think look attractive right now, given the churn that has happened in the market?
Yeah, so when it comes to valuation, and let's say look at sectors like banking, for example, that looks perfectly fine for us, because when you take into account the rising, I would say that the credit growth is likely to pick up, for example, because the country is moving on to the investment path in the near term. So we think with economic recovery, credit growth is likely to improve, and the bank balance sheets are much more cleaner today. Many banks, our focus has been on banks which have good amount of current account and savings account deposits, that gives them an advantage as far as low cost of funds is concerned. And banking capital, many banks are good, strong with the capital availability. So from this perspective, we think that is one sector where the valuations have not moved up in the recent times, and there is a clear growth opportunity as far as the return on asset is concerned. The trajectory is seen to be improving. Secondly, automobile, as I said already, that sector has done well, but we think that the penetration levels are still very low. So you talk about, let's say, cars. We have only 3% penetration. We talk about the affordability going up. The aspirations are very high, and again, the domestic demand potential is very strong. And the current problems about component supply availability are getting normalized, they are getting sorted out. So that is one sector where we are positive. Again, sectors like IT, for example, we have some strategies in the UTI which are betting on IT still because of the strong return on capital employed, and as well as the cash flow situation, cash flow position that these stocks have. And digitization is a very structural trend. The clients of these IT companies are actually, they have seen their balance sheet strengthening over the last 4 5 years with cash balances going up, and they look at IT as not as a discretionary spend but a necessary spend to stay competitive in their businesses. So that is another sector where we are positive. Healthcare is another sector where we think in India there is a long growth runway as the insurance penetration goes up, the healthcare awareness goes up, and unfortunately, India is known to be a diabetic capital, for example. So these chronic ailments are likely to grow well, and companies have invested in their R&D efforts to bring the capabilities to move up in the opportunities that may be there in complex generics, injectables, as well as opportunities to manufacture. And India is evolving as uh, the second option to China as far as the manufacturing and key material is concerned, as a supply source. So I think these are some of the themes, I would say, or sectors which we are positive on, Karunya.
Okay. All right, Swati, on that note, we're going to wrap it up right here on today's edition of Markets Weekly. Many thanks for joining in and sharing your views on asset allocation, managing your portfolio during market uncertainties, and the themes to bet on. Great chatting with you, and thank you for coming in.